Benefits of commercial paper to the investor. What are the benefits investors enjoys? One, high yield. If you invest in a bank FD, government security, how much will you earn? 6%, 7%, 8%. But if you invest in commercial paper, you can earn a higher rate of return than that. Okay. So that is an attraction for the investor. Of course, the disadvantage is that there is a risk involved because these are unsecured instruments and issued by corporates. But the risk is relatively less as these instruments are for a very short period. In short period, the risk is less and they are credit rated by the credit rating company, and also the banks, the corporates have to follow RBI guidelines. So the risk is more an imaginary risk than the actual risk, because normally they do not default. Investment managers are increasingly looking to match investable excess cash with higher yielding security as compared to those presently available in the market. So you are suppose the treasury manager of a big corporate and you have surplus money. So you have several options for investing. You can invest in treasury bill or bank FD, government security, commercial paper, certificate of deposit. Which one you would choose? So most probably you may choose commercial paper because the rate of return is very high. Third benefit or second benefit, portfolio diversification. This helps you to find one more avenue to park your funds. Okay. Investors look for new avenues where they can park their surplus money. Commercial paper is one more avenue where you can park. And what about the flexibility? The maturity period is 15 days to 1 year. But you can also transfer it to other investor in case if you require. So you can match your cash flow requirement according to your period for which you have surplus. You can choose the commercial paper and you can even transfer it also. Keep that in mind, and that makes the instrument very liquid, and that is why it is a favorite instrument of the investor. Liquidity in CP is generally provided by a dealer offering to buy it back from an investor prior to maturity, for which a market quote will be available. So you can simply say these are transferable. These are transferable in secondary market. The investment in CP is quite liquid. You can sell it. There is no minimum lock-in period as such. Like in certificate of deposit, you have a 1 month lock-in period for the primary investor. And yield on commercial paper is calculated in the same manner as calculated in commercial bill or certificate of deposit. You make it certificate of deposit. So the formula is same. Formula for calculating the effective yield is face value minus issue price upon issue price into 365 divided by n into 100. Instead of 365, if suppose months are given, take 12 by n. Okay, and then sometime either this may be missing, in some question issue price is missing, in some problem n is also missing. You just have to solve the equation. Okay. Now ready for problems. Go to end of the chapter. Question number 2. Question number 2. XYZ Limited has issued commercial paper as per the following details. Date of issue 17 January 2022. Date of maturity 17th April 2022. Number of days they have counted. Such a nice institute. 90. Don't challenge it, even if it is there or it is not there. If it is given, use it. And effective rate of interest, use the word effective, 11.25% per annum. Face value rupees 5 crore. What was the net amount received by the company on the issue of commercial paper? This is an actual CA exam question. So first 20 seconds will be allowed to the students. What was the net amount received by the company on the issue of commercial paper? It has to be less than 5 crore. Write neatly so that you can revise it also. Can they ask such questions in my exam? Yes, you can. They can ask you. Entire 50 mark is not related to the case study which is drafted at the beginning. Some questions are unrelated to the case study, like a small question for 3-4 marks. Okay. So what is the formula of effective yield? Is face value minus issue price upon issue price 365 by 90 into 100. This is given to you. How much was that? 11.25. And face value is 5 crore. Say yes. 5 crore. Issue price assume X. Now anybody who wants to answer. Crore 86 lakh. 38,000. 132. Wait. It's written there. No, then don't bother. Take 365 only. Nothing is given, you take 365. If you see some of the suggested answers given below, in all 5 suggested answers, I think they have taken 365 below. Problem for cell practice. Yes or no? Take 365. Now wait, what is your answer? 50,449. Oh, wonderful. Which is right? This answer is right. 12,000 rupees is your 4-month stipend. Do you know that? 40 hours per week into 4 weeks into 3 months. It's an amount for that many hours of hard work. This is the right answer. Next question, one more trial that they also asked in the exam for 3 to 4 marks. Following are the details regarding a commercial paper. Date of issue 17 January 22, date of maturity 17th April 22, number of days 90, effective interest rate question mark. Add this word effective. Now I'll tell you, even if in the exam effective word is not there, but if this question is asked, you solve for effective interest rate. Face value 10 crore, net amount 9.5. What is the implicit? Now here they have mentioned what is the implicit means effective interest rate. Same formula, implicit interest rate or effective interest rate is equal to effective interest rate equal to face value minus issue price, both are given in the problem, upon issue price into 365 by n into 100. There are few questions printed for cell practice below. Just see. And in all those questions, They have used 365 days to solve. Yes or no? Just have a quick look at the answer of the cell practice problem. Anybody got the answer? 20 point? 21.35. So this is the effective rate of return. That means investor can earn up to this much rate of return on a commercial paper. Right? Dear student, come to one 6-mark question from the exam. From the following particulars, calculate 1. The effective interest per annum as well as total cost of funds to ABC, which is planning a commercial paper issue. Issue price 97,350. Face value 1 lakh. Maturity 3 months. Issue expenses brokerage is 0.125%, underline, for 3 months. For per annum calculation, you multiply it by 4. Rating charges is 0.5% per annum. And stamp duty is 0.125% for 3 months. Again, underline 3 months. So, student has to be very careful. This is 3 months, this is per annum, this is 3 months. All these you have to convert into per annum. Add it to the discount rate also here. That will give you the total cost of funds. Right. Dear student, first we'll write step 1. What is step 1? Effective interest rate per annum. Effective interest per annum formula, face value minus issue price upon issue price into 12 by n into 100. Sir, why you are writing 12? Because in this question they have mentioned somewhere 3 months in the problem, and there is no way you can calculate the days. So take 3 months only. Solve. Is it 10.89%? And then step 2, one more question. What is the total cost of funds to ABC? Total cost of funds to ABC, right hand side one percentage column. So there are 4 costs. One is your effective interest, main cost. Which is 10.89. In addition to that, they will incur brokerage also. Brokerage is 0.125, but that is for 3 months. So if you want to find out the annualized value, because other figures are annum, multiply by 4. How much is that? 0.125 into 4. Is it 0.50? See, you have to compute annual percentage so that it is comparable with any other alternative option also. Rating charges is already given 0.5% per annum. Per annum, don't multiply by 4. And then you have been given stamp duty 0.125% into 4 because it is 3 months. So multiply by 4. Point number E. Therefore, total cost of funds A plus B plus C plus D. Close it. Answer 11 point. Okay, 12.39%. Is the answer right? Good. So we have completed 5 questions. And mark important because in the SFM exam, they had asked this question earlier. Now this topic is shifted to this capital market and financial services subject. This is more detailed one compared to what it was there earlier. Okay. All of you have written? One more question from my side. The price of rupees the price of rupees 8,000 face value commercial paper is rupees 7930. If the annualized yield is 4%, when will the paper mature? So this time N is missing. This time N is missing. Okay. So I will give you the formula on the screen. Have you written the question? Solve. After solving, give me days. 81 days. In the place of F, how much you will write? 8,000. And what was the issue price? 79 divided by 7930 into 365 by N or M into 100. And how much is the yield I have given? 4. Is it 4? So after solving, the answer is approximately 81 days, right? Approximately. Dear student, come back. Come back to the long discussion on theory of this chapter. Difference between commercial paper and commercial bill. Are they same or different? They are different. Commercial bill and commercial paper are very different. So read your notes, left side. Commercial bill, which we saw in the previous lecture. So commercial bill arises from sale transaction. Okay. That means Ram sells to Shyam and then he draws a bill. Banks finance commercial bills. Who does the financing? Banks. Usually the bill consists of an invoice drawn on the buyer, the documents to title to goods, and a bill of exchange. The bills are given to the bank for advancing money against sale of goods. Commercial bill financing is post-sale finance. Okay. The bill of exchange may be on a DP. What is DP? Document against payment, or DA, document against acceptance terms. And commercial paper is an unsecured, which we learned today, and discounted promissory note issued to finance the short-term credit needs to large institutional buyers. So who are the borrowers here? Usually the large corporates. Okay. And who are the investors? Any investors like bank, corporations, and foreign governments. Any investor can invest. Who uses this instrument? Large corporates use this instrument. Okay. Banks, corporation, and foreign governments commonly use this type of funding. You delete that line. Some mismatch is there. This is the disadvantage of copy paste. Okay. but not me, your boss in Delhi. I have passed. Still, I come under the regulation. Oh, how did you know? Now, in the next segment, we will discuss CRR and SLR. We'll go through it little fast because in one previous chapter we have covered. Not only that, bad news. In one more next chapter, we are going to cover subsequent chapter CRR and SLR. So there it is in more detail because some calculation is also involved in that chapter. Today we'll not take example, we'll take in the banking company only because that time I'll give you a balance sheet of a bank, and from that balance sheet you have to use the correct figures and find out the CRR and SLR. Okay. So what is CRR? Long back 12th standard is the amount which a bank is required to keep with RBI. Currently it is 4%. What is 4%? 4% of what? 4% of time and demand deposit, right? 4% of what? Many people know 4%, but when you ask them to calculate, are 4% of what? So 4% of your time and demand deposit. That means saving account, current account, FD account. If you have issued CD, that also will be considered. That is also a time deposit. Time deposit means FD, demand deposit means saving and current account. CRR is a fraction of the total amount of deposits collected from the customer and kept as reserve either in cash or as deposit with the central bank. Read this paragraph along with other paragraphs in other chapters also. Okay. Then CRR is prescribed according to guideline of the central bank. What is the purpose of CRR? The basic purpose is to ensure that banks do not run out of cash to meet the demand of their depositor. Banks have to honor their customers' demand. Some amount is kept aside with RBI. It reduces their lending ability. It reduces their lending ability, and therefore CRR is also used to monitor the money supply in the economy. Question: if the RBI wants to increase money supply, should CRR be reduced or increased? Reduced. If RBI wants to decrease the money supply, CRR should be increased. Okay. So CRR is therefore a crucial monetary policy tool and is used for controlling money supply in the economy. Next is example. A depositor deposit rupees 10,000 in a bank. Out of 10,000, bank has to keep 400 rupees as CRR. This work as a type of contingency fund to ward off any payment crisis in future. It's like a contingency fund. Separately you keep so that in future if the need arises, you can use it. In this chapter only this much discussion on CRR. What is SLR? It is the amount of reserve which the banks have to keep it with themselves only. And where they have to park this money? They have to park this money in highly liquid assets. Example of highly liquid asset where they will park this funds: cash, gold, and non-mortgaged securities, government securities, okay, or treasury bill, silver, so that they can liquidate it and convert into cash. Again, the idea of maintaining SLR is to keep liquidity with the banks so that they can meet the requirement of their customers on time. So bank which subscribe to treasury bill also qualifies for SLR requirement. There is a reporting Friday. When you have to calculate it? On the alternate Friday. On the alternate Friday, that means fortnightly. Fortnightly you have to calculate the SLR and report it to RBI. Every second Friday One Friday you don't calculate, next Friday calculate. Check what is your time and demand deposit and then report it to RBI. Also report how much is your investment in SLR securities or SLR assets. If there is a shortfall, what will RBI do? RBI will penalize the bank for not maintaining the SLR. And if you continuously violate this CRR or SLR requirement, they may even cancel your license. At present, SLR is 20%. Right there, refer RBI. Wherever I will write refer RBI means you have to check few days before your exam. Even few days is okay. What are these numbers now? Latest number. Okay. Now example of SLR. Government comes out with a tax-free bond of rupees 5,000 crore which RBI issues on behalf of the government. SBI subscribes to 500 crore. Will this be treated for SLR calculation? Yes. Yes. Investment in bonds are treated as SLR instrument. So the whole amount will qualify as SLR. So in this chapter, this much is the discussion on SLR. Some more discussion is pending which will be covered in banking company. Now, next few paragraphs are how are interest rate determined in money market. And we'll also discuss some of the world famous benchmark rates like LIBOR, MIBOR, like this. Okay. So who determines the interest rate in the money market? RBI, government, or market forces? So market forces. Earlier, in the regulated era, pre-regulated era, a lot of RBI interference was there. Even your bank FD rate they used to determine. Saving rate they used to determine. Lending rate they used to determine. Okay. So banks were just like an agent of RBI. But now banks are given a lot of freedom. So call money rates were regulated in the past by RBI or by a voluntary agreement between the participant through the intermediation of the Indian Bank Association. So earlier they used to settle the rate among themselves. They enter into an agreement through this association of bank called IBA. But now this paragraph is actually useless. Interest rates have been deregulated and left to the market forces of demand and supply of short-term money as part of financial sector reforms. Now this line you will read carefully. The call money market witnessed turbulence. Turbulence. Have you heard turbulence? What is turbulence? Vibration. When you fly in the aircraft and when the flight reaches at the top and sometimes there is a huge wind blowing, your aircraft starts dancing. That is turbulence. And Indian economy is always in turbulence. You are right. When the rates shot up to as high as 130%. But that is an exception. But you can imagine what can happen if you leave everything to market forces. Okay. The reason for increase in volatility in the call market. Why the call market is so volatile? Now, yesterday also in some paragraph it was mentioned. Combine these two paragraphs. Some more points they are mentioned in this paragraph. Advance corporate tax payment. How does that affect the call money market rate? Does it affect? On advance payment date, corporates have to pay to the government. So they will need money and they don't have cash in their bank account. So they will borrow. So they will borrow means it will put a pressure on a bank to lend. So one bank will again borrow from another bank. So that is why advance corporate tax payment, because some corporates like say Reliance, They have to pay advance tax of hundreds of crores of rupees in one installment. So during on that day they'll withdraw money from their bank. Bank have to keep that money in their account. Can bank say no, today you don't pay advance tax, you come tomorrow, pay tomorrow? On 15 December, they have to keep so much cash so that all the all the account holders will be able to pay their amount. Investors' interest in primary and secondary capital market, including the units issued by mutual fund. Now banks have lot of competition from mutual fund now as far as raising of deposits are concerned. More and more people are investing in share market because they have started understanding. More and more people have started investing in mutual fund. So banks are not getting enough deposits from the public. So they have to borrow from other banks. So call money market is volatile. Large withdrawals on bank's credit line. That means bank gives credit line to their customer. Sometimes there is a large withdrawal. Imprudent practice of the bank. Mismanagement of liquidity. Development in the foreign exchange market also. That means demand and supply for foreign exchange also affect the money supply. True or false? Demand and supply of foreign exchange will also affect the money supply. If you have to make payment in foreign exchange, you have to convert rupee into dollar. So demand for rupee goes up. Okay. So foreign exchange market can also affect Indian money supply. If a lot of people bring foreign exchange into India, foreign exchange comes into India. It gets converted into rupees. Okay. Similarly, when you make the payment, rupee gets converted into dollar. So it creates a pressure on the bank's funding. Banks were reported to have invested in government securities by borrowing on call to earn the spread when call rates were low. Banks are also smart. They borrow when call rates are low and park the money in government security at a higher rate of interest. Now this table shows you that who are the issuers, who are the investors, okay, what are the instrument and what are the maturity period. Just a general knowledge question, okay. So who are the issuer? Government. Central government issues GOI. What is GOI securities? Government of India securities. Maturity period can range from 2 to 10 years. And investors can be bank, LIC, GIC, UTI, FI, FII, MF, MMMFS, PFs, pension fund, corporates, NBFCs and RBI. Again central bank, treasury bill, whose maturity can be 3 months to 1 year. Actually it is 14 days to 1 year. Banks, same investors they mention LIC, UTI, GIC, PF, mutual fund, MMMF, pension fund, corporates, NBFCs, RBI. State government, issue state government security, maturity 5 to 10 years. Which means state governments are not allowed to issue treasury bills. And who are the investors in such state government security? Usually banks, UTI, LIC, GIC. Financial institution, provident funds, mutual funds, MMMS, pension fund, corporates and NBFCs. RBI is not here. Then next is government agencies. They issue government guaranteed bond. 5 to 10 year. Like you have National Highway Authority of India bond, Rural Electrification bond, which I think has a maturity of 5 years. And who are the investors? Banks, UTI, LIC, GIC, FI, PF, mutual fund, MMMF, pension fund, corporates and NBFC. It seems they have just copied and pasted only. Even investor like you, retail investor can also buy these bonds. Right there, retail investor. PSU, Public Sector Undertaking, PSU bonds. Maturity is 5 to 10 years, and the same names they have mentioned again here. Private sector corporate, they issue corporate debenture, and the maturity can be 1 to 12 years. Investors can be UTI, other mutual funds, LIC, GIC, FI, MMM, and corporate, right? Retail investor also. Banks also. Private and public sector corporates issue commercial paper whose maturity can be 15 days to 1 year, and investors are usually banks, mutual fund, financial institution, money market mutual fund, corporates. You also write high net worth individuals, HNI, high net worth individual like you. Okay. Banks and financial institutions issue certificate of deposit. Maturity 3 months for a bank and 1 to 3 year for financial institutions. And the investors are bank, FIs, mutual fund, money market mutual fund, corporates. Again write high net worth investors. Now next is discussion about interest rates. So one is money market MIBOR. You also add this heading MIBOR rate. Thomson Reuters. This agency, they calculate MIBOR. Next, can you see this heading? What is the full form of MIBOR written here? Underline. MIBOR means Mumbai Interbank Offered Rate. In India, Mumbai Interbank Offered Rate. In London, LIBOR. Karachi, KIBOR. Karachi Interbank Offered Rate. Yes. Huh? Which? Pune. Now, after some time, you will ask Sadashiv paid interbank offer rate nalayak. Prestige point interbank offer rate. Let it be. Do not overstretch imagination. MIBOR Thomson Reuters overnight call money rate. This is published by an agency called Thomson Reuters. It's a very famous company, Reuters. Okay. So this company publishes this rate, and therefore it's called MIBOR Thomson Reuters overnight call money rate. That is the rate of interest charged by one bank to another bank in the overnight call money market. MIBOR stands for overnight call money rate in India, which is getting fixed by Thomson Reuters every day. Just like LIBOR, it is MIBOR. MIBOR is having an alternative leg also, an alternative rate which is known as OIS. What is the meaning of OIS? Overnight index swap. Now in your SFM new syllabus, you have this overnight index swap also in the calculation. Yes or no? Let me check whether you remember such things exist or not. Yes, it is one bank exchange their fixed interest against floating interest for a very short period, and the interest is calculated on a compound interest on daily basis. Daily compounding is done, and then at the end of that period, which is 7 days or 10 days, the differential amount is settled. That is called overnight index swap. So MIBOR is having an alternative rate which is OIS. OIS, now write the meaning of OIS briefly. Meaning of OIS. OIS are an interest rate swap. OIS are an interest rate swap involving the overnight rate being exchanged for a fixed interest rate. being exchanged for a fixed interest rate. So basically, like any swap, it is used for hedging also. Okay. So the sentence in your book continues like this: overnight index swap refers to hedging of local currency in local currency books and in the local country. Hedging of local currency in the local currency books in the local country means rupee in the books of account maintained in rupee in India, which effectively means hedging of INR denominated asset or liability by an Indian corporate in INR books and in India. Because if you have debt instrument, as the market rate of interest changes, the value of those debt asset or debt liability also changes. So you can use overnight index swap to hedge the value of such assets and liabilities. OIS also means, say, hedging of USD denominated asset or liability by an American corporate in USD books in NY. What is NY? New York. So there is a small diagram they have given to you, copied, pasted from some unknown sources. Overnight index swap, left side hedging of local currency asset, right side hedging of local currency liabilities. Example of local currency asset: term deposit, money market mutual fund, intercorporate deposit, INR balance in books, and other local currency balances. Example of local currency liabilities: term liabilities, working capital liability, swap liability, or any other local currency liability. So overnight index swap can be used to hedge these assets and liabilities. For the timing, this much. For more information on OIS, refer your SFM. Refer your SFM, over the counter derivative chapter. Over the counter derivative chapter, refer SFM. Now the next rate which is worldwide used is called LIBOR, or some people pronounce it as LIBOR. So what do you want to say? LIBOR or LIBOR stands for London Interbank Offered Rate, or it is also called ICE LIBOR. ICE LIBOR? I will tell you what is ICE LIBOR. Is a benchmark rate that some of the world's leading banks charge each other for short-term loans. So LIBOR is an international benchmark rate for short-term borrowing and lending, and one bank charges to other bank. Interbank. Okay, so this forms a benchmark for other interest rate in the market. Other interest rate in the market will be around this LIBOR. If you have a good credit rating, it will be little more than LIBOR, but bad credit rating, much more than LIBOR. So what is the full form of ICE? It stands for Intercontinental Exchange. I, inter, C, continental, E, exchange, London Interbank Offer Rate. Earlier it was called BBA LIBOR. Which LIBOR? BBA LIBOR. Now it is called ICE LIBOR. It serves as the first step to calculating interest loan on various loans throughout the world. It's quite popular. Okay, that means if you want to find out what is the ongoing interest rate in the world, you would refer to LIBOR. It's not that you will pay LIBOR, but at least you have some benchmark, and then you can accordingly decide what interest rate you want to pay. Okay. So LIBOR is a standard rate, benchmark rate used in global transactions. LIBOR is administered by ICE Benchmark Administration, IBA. ICE means Intercontinental Exchange, and there is a body which looks after this LIBOR calculation. Just like the Thomson Reuters is for MIBOR. And it is based on 5 currencies. So this can be a question for you. Which are the 5 currencies for LIBOR calculation. So these are the 5 world famous strong currencies like Euro, USD, Pound, JBP, Japanese Yen, JPY, and Swiss franc, CHF, and serve 7 different maturities. That means LIBOR is available for 7 different maturities. Overnight means for 1 day or 1 week, 1, 2, 3, 6 and 12 months. So if today you want to enter into a contract for 6 months, you will refer 6-month LIBOR. If you want to enter into a contract for 3 months, you will refer 3 months LIBOR, like this. So total how many rates will be available? Can you guess? 7 maturities, 5 currencies. So therefore 7 into 5. At any point of time they will give you 35 rates. So they will ask you in which currency? USD. And which maturity? 7 days. There is a LIBOR for that. For each currency and each maturity there will be a different LIBOR. Okay. The most commonly quoted is 3-month USD rate. Out of 35, which combination is mostly used? Mostly 3-month USD rate. Now, LIBOR, also called ICE LIBOR, is the world's most widely used benchmark rate for short-term interest rate. It serves as the primary indicator for average rate at which banks that contribute to the determination of LIBOR may obtain short-term funds in the London interbank market. So this is in short the rate at which banks in London can borrow from other bank. London interbank market. As you know from your SFM knowledge, London is one of the biggest financial centers in the world, bigger than Mumbai. Okay. Currently there are 11 to 18 contributor banks for 5 major currencies. So this LIBOR is actually an average rate, not just one rate, of these 11 to 18 banks who give their quote in 5 currencies, giving rate for 7 different maturities. And this association which we saw just now, IBA, they will take the rate from these 18 banks and they will do some averaging. And how do they calculate? We don't know, but this is like average of those rate quoted by different banks. Sometimes there is a manipulation there also. Okay, don't write that. LIBOR's primary function is to serve as a benchmark reference rate for debt instrument, including government and corporate bond mortgages. So if an Indian company wants to raise funds in say USA, they can see what is the USD LIBOR rate and then accordingly they will negotiate. It can be used for mortgage rate, government bond rate, student loan also, credit card rates, as well as derivatives such as currency and interest swap, among other financial products. So world over, whenever you need some reference rate, the rate which is used maximum is LIBOR. Okay. For example, there is an example also given. Take a Swiss franc denominated floating rate note. Floating rate note means what? A floating rate debt instrument. Floating rate debt instrument. Note means debt instrument for shorter maturities. And bond means higher maturities. Okay. So when normally the maturity is less than 5 years, we call it note. And it is more than 5 years, we call it bond. In short, they are directly called floater. So floater means a floating rate bond, and that pays coupon based on LIBOR. So how they have decided to pay the coupon? LIBOR plus 35 basis point margin, means LIBOR plus 0.35%. 1 point means 0.01%. 100 points means 1%. So what is the rate of interest this Swiss entity will pay? They will pay LIBOR plus 0.35% every year, and this is a 1 year LIBOR. So here they have chosen 1 year LIBOR. So when will the LIBOR be reset again after 1 year. Again after 1 year, if the LIBOR changes, they will revise the interest rate. Each year the coupon rate is reset in order to match the current Swiss franc 1 year LIBOR plus the predetermined spread. Okay. Now for example, they have tried to simplify it for you. If 1 year LIBOR is 4% at the beginning of the year, this bond will pay 4.35% of the par value at the end of the year. Now the spread, that is 0.35%, who decides that? That is something which you have to bargain. Depends on credit worthiness of the institution issuing the debt. Okay. So better credit rating means lower spread you have to pay, and poor credit rating means higher spread you have to pay. Your cost of borrowing goes up. Another prominent trait of LIBOR is that it helps to evaluate the current state of world's banking system. That means in general, globally, whether the interest rates are going up or coming down. How will you know? By looking at LIBOR. If LIBOR rate in general is going up, means we are expecting that interest rates will go up. Next is ICE LIBOR. Is it there in your book? ICE LIBOR was previously known as BBA LIBOR. You will be interested in knowing what is BBA. In India, BBA means Bachelor of Business Administration, which is a useless thing. Anyway, that is my personal view. Okay, 3 years of low cost entertainment. And our CA course is many years of high cost entertainment. So this was British Bankers Association. Okay, don't tell anybody I have said something like this. They might file a case against me. Until February 1, 2014, the date on which ICE Benchmark Administration (IBA) took over the administration of LIBOR. Actually, there was some scam during this period, okay, 2014. That LIBOR was manipulated, so they have changed the administration. But don't write all this, now that is a history. I think some of them have gone to jail also, those who were managing these rates. So it's not that India has only corruption. Corruption is a natural instinct. Okay, next line. We'll discuss now money market instrument GSEC. That means government securities. Now here also they have made a good summary of different types of money market instrument. The RBI is the issuer of GSECs, okay, on behalf of the government. Government security can be central government, state government or treasury bill. Already discussed. Now in your book there is a table drawn which I am going to read from your book only. The different types of government securities are. The different types of government securities are dated security, zero coupon or deep discount bond, zero coupon or deep discount bond. Then next is floating rate bond. Okay. Then next is capital index bond. So see their features. Dated securities means long term securities. Okay. Because they are transacted on a secondary market, so you can buy and sell anytime. But ideally, it should not have been written here also. So dated security issued at par value. Zero coupon bond, as you have studied, are issued at discount to the face value. Floating rate bonds are issued at face value, and capital index bonds are issued at face value. Now what about the interest or coupon rate? So next line is interest or coupon rate is fixed at the time of issuance. As you know, zero coupon bond do not carry interest. Floating rate bond interest rate is floating as it is linked to a predetermined benchmark rate like MIBOR, LIBOR or INBMK. What is INBMK curve? Write down. INB stands for Indian, BMK means benchmark. So it is again in bracket Thomson Reuters Indian benchmark yield curve. Okay. And capital index bond interest rate is a percentage over inflation benchmark. The purpose of capital index bond is to protect you from inflation. Maybe WIP. What is WIP? Wholesale price index. Or CPI. What is CPI? Consumer price index at the time of issuance. One more line right from my side also. CIB are bonds. CIB are bonds whose base payment rises. Whose base payment rises and falls with the consumer price index. With the consumer price index, CPI. Consumer price index means CPI. That means as the CPI will go up or down, the payment made to investor will also change. It offers investor a hedge against inflation. It offers investor a hedge against inflation. So basically what happens, India is a country with high inflation. Interest rate is very low, inflation rate is very high. If you earn 6% return on a bond where the inflation is 8%, you are not earning anything in real sense. You are losing the purchasing power of your money. You will not be able to buy the same basket of goods and service after 1 year if you earn 6% on your investment and the inflation is 8%. So then people will move away from government bonds. Government will not be able to raise funds. So therefore now the suggestion given by RBI is that we should issue capital index bond so that it will give investor some percentage over and above the inflation rate. Okay. So to hedge the investor against inflation, this capital index bond are issued. Next is dated security. The term of the security is fixed. Zero coupon bond, the term of security is fixed. Floating rate bond, the term of the security is fixed. And capital index bond also, the term of the security is fixed. Redemption. The security is redeemed at face value on the maturity date. This security is redeemed at face value on the maturity date plus zero coupon interest on the security. No interest is paid. No interest. The difference between the first point, issue price, and the face value itself is the income of the investor. And floating rate bond, the security is redeemed at face value on maturity. Capital index bond, the security is redeemed at face value on the maturity. Okay. Next is recent development in money market. Debt securitization. One of the important events in the last 20 years, not even 20, okay, let's say 15 to 20 years, is the debt securitization process. Have you studied debt securitization? First, I'll give you a brief background, then we can read the notes. This is there in your new SFM course also. Okay, in the theory part. You have a lot of theory parts in SFM. So this paragraph or this segment is common in new SFM group 1 and this chapter. Now let us say there is an investor, not investor, customer. This customer goes to HDFC Bank and he borrows money. So now in the balance sheet of HDFC, loans and advances will appear. If many such customers come, then over a period of time, the balance in this loans and advance account will keep on increasing. But the balance in cash and bank account will decrease. Because all their cash and bank have been used to give loan to this customer. Now a time will come when their cash and bank balance is now no more sufficient to give more loans to the new customers. Theoretically, let us see it happens. So what is the course of action HDFC will follow? 1. Issue equity shares, which normally they will not do. Dilution of control, cost of equity is highest, several regulations are involved. Okay. Second, you issue preference share, again costly affair. Preference share is a costly instrument compared to others. And next you issue debentures and take loan, take borrowing. But your debt equity ratio is already very high in case of banks, you know that. And you don't want to further increase your debt equity ratio. Or you may not have enough security to offer also. For whatever reasons, you don't want to bring more borrowing in your balance sheet now. Then what you do? There is one more option. You can bundle these advances, pack these advances and transfer it to another company which is called special purpose vehicle, sometimes asset reconstruction companies. Okay. So these loans and advances will be transferred. And you know that you are going to receive money from these loans and advances over a period of time. What this SPV does, it issues securities to the investors. It issues security to the investor, normal investor, like you can also invest. So suppose this amount is 300 crore rupees, it may issue 3 crore bonds of rupees 100 each. So what happens? It is able to raise the funds from the investor. So what is happening? First you are creating the receivable in your books by giving loans. Okay. Suppose to 30 investors, you have given loan of rupees 10 crores each, for example, for simplicity. And that it becomes 300 crore. You issue 3 crore debenture of rupees 100 each. So investor will invest in that bond or debenture issued by SPV. SP will raise funds and transfer it to HDFC. So now in the books of HDFC, the loans and advances will be substituted by cash and bank, without disturbing the liability side. I have not touched the liability side. It's like I have sold my receivable, sold my financial asset, that is receivable, and I have raised the funds. And then again I can give more loan. After some years, again my balance sheet will have loans and advances. Again I will recycle. So securitization is also called a process of recycling of funds. It's a process of, if properly executed from the small asset base, you can do more and more business. You can generate more and more income. Okay. It improves your capital adequacy ratio. It improves your return on investment. It reduces your risk. Again, there are two types of securitization, with risk and without risk. With risk means SP will be responsible for any bad debt. Without risk means HDFC will continue to have the risk of bad debt. Accordingly, the interest rate etc. will also be negotiated. Terms and conditions will be negotiated. Every party benefits in this process if it is executed properly. Customers, more and more customers can avail the loan from HDFC now. HDFC is a specialist institution in lending. HDFC is a specialist institution in lending because they know how to identify a good customer, how to check his credit worthiness, how to do the effective documentation when they give the loan. That requires a specialization. And how to recover money also if the customer doesn't pay. SPV is a specialized entity in this securitization process, how to issue securities to the investor because they know who are the investor to approach, what are the formalities for issue of securities etc. Issuing security is again another set of skill required. Okay. Investor in the last box are also benefited. One more avenue to park their surplus money. And most of these securities are rated by credit rating company. They are backed by collateral in the form of receivable. Receivables are backed by the houses or any other property which the customer gives to the HDFC. Even if customer doesn't pay, HDFC can sell their property, whatever they have taken while giving the loan. So risk is less. Risk is less. And many times in order to be doubly sure, the investor insists that the instrument should be insured with the insurance company. Okay. So if something goes wrong in the whole process, there is an insurance also. So this is called debt securitization. Very useful for institutions like banks and financial institutions who have lot of receivable in their balance sheet. If you don't do anything, they become illiquid asset. What is the cash flow from this loan? Suppose you have given 30 crore rupees to a person. At the end of the year, he will give you only 3 crore rupees interest. That's it. Maybe some installment, 2 crore. 5 crore rupees he will generate and it will sit in the balance sheet till next year now. No further cash flow generation. So it becomes an illiquid asset. Securitization is a process of converting illiquid asset into liquid asset. Securitization is a process of converting illiquid asset into liquid asset. It is a process of recycling of fund. You will say all this we have already discussed in the intermediate syllabus also. You are right. All this we have also discussed in the SFM syllabus of group 1. You are right. But it is again a part of this chapter also. Everybody can do debt securitization. No restriction. In USA there was a singer, David Bowie. He was going to receive royalty from future sale of his album. He issued bonds which will be redeemed out of the future sale proceeds of that music album. Okay. I have also issued, example, hypothetical, bond and it will be redeemed out of the future sale of books and pen drive. Okay. So you are able to convert many times your future receivable into cash play itself. Karan Johar can also securitize. He is going to release 5 movies next year. He can raise bonds, raise money, pay out of the ticket sale of those movies. But again, you need people who would invest in such bonds. If you have a good rating, you can do that. Debt securitization refers to converting retail loan into wholesale loan. First, what we did, we gave loan to many customer. Somebody takes 1 lakh, someone takes 10 lakh, and then it becomes a huge amount. And then reconverting them into small loan. We issued 30 crore bonds of rupees 10 each. Okay. For example, a bank lends 10 lakh rupees to 300 borrowers as a part of its loan portfolio. So it will become 30 crore rupees. Okay. The total debt in the books will be 30 crore now. 10 lakh into 300. So what it will do, by way of securitization, the bank can break the entire portfolio of loan or debt of rupees 30 crore into paper of rupees 300 each, for instance. That means they will issue 10 lakh debenture of rupees 300 each and market it in the secondary market to the investor, and it will be sold to thousands of investors, those who want to purchase. It's basically you are taking funds from one set of investor and giving it to the customers. That is securitization process. It's a very innovative idea in the field of finance. India is still growing as far as securitization is concerned. In USA, it is a matured activity, and I have read that the yearly volume is trillions of dollar. How many dollar? Trillions of dollar in debt securitization. Now we will continue tomorrow.